Hello, my name's Angus Murray. I'm the Chief Investment Officer of Castlestone Management and on the Investment Committee for Next 11 Emerging Markets Fund. This is a presentation of 24 slides that I'm going to give over the next 6 to 8 minutes, just giving a review of the fund and an outlook as to why we find this asset class an interesting one, not only today, but for the course of this decade. Going to slide 2, the reason that the Next 11 acronym came about was a development in 2005 by Jim O'Neill at Goldman Sachs. He basically chose those populations which he thought would challenge the G7 countries by 2050, that they were large and young populations, they had levels of urbanisation, and the markets were developing and there was an investor focus. Hence the acronym of Next 11, although interestingly none of us invest in Iran due to the embargo on that country at this point in time. So it was really a total of 10 individual countries. The other thing that we looked at is, why do we think the next 11 countries are going to outperform, or have they outperformed over the course of the last decade and also this decade? And we think that relates to debt to GDP. Basically, equity markets with countries of low levels of debt to GDP are going to outperform those countries with higher levels of debt to GDP, and we'll discuss that throughout this presentation. And lastly, on this slide, we just wanted to highlight how most people's portfolios are currently structured today, which is a combination of a GEMS fund or emerging markets fund and a BRIC fund. The problem with that is that there is a 41% country overlay, so you do not get diversification. You are much better out owning a combination of the next 11 countries with emerging markets, or alternatively the best exposure in our view is next 11 with BRIC, where there is no country overlay. Going on to slide 3 here, we can see the history of the development of the acronym of Next 11, how Jim O'Neill coined BRIC in 2001, and then how he developed the concept and the acronym of Next 11 in 2005, and then how funds have recently opened up with regard to giving or allowing investors to have exposure to these Next 11 countries, although we only invest in 10 of them. This slide 4 is the countries geographically diversified. You will clearly see later on in the presentation that Mexico, Turkey, Indonesia and South Korea are by far the most dominant with regard to economic activity as it stands at the moment. The median populations on slide 5, just taking a look at the broadly young populations and therefore the lack of burden that those populations have on the government in terms of supporting them from either healthcare or alternatively social security. Slide 6 was an economic outlook that the development of the world is basically coming, that we are going to peak with regard to our GDP growth globally in the decade 2010 to 2020. So it is going to become an argument of relative growth rates, and that's where you see the next 11 countries really begin to develop and show their differences over the course of the next decade. And you can see that again on slide 7, where the next 11 countries clearly have higher growth rates than those of, say, the G7 countries. And we think that's why you are going to get a better performance from owning equities in these type of countries than more of the developed world. Slide 8 and 9 link together just two visual slides to show the increase in wealth that is coming through in these countries. What we're looking at here is the number of people in countries with earnings above 30,000 US dollars. You can clearly see the importance of China in terms of these charts, but you can also see the importance that Next 11 has in terms of a constant growth rate out to 2050, whereas it takes a number of years for the development of the number of people in India to come through, which really only occurs in the decade between 2030 and 2040. Slide 9, I think the most influential information in this area comes from the fact that in the period up to 2025, you can see that the next 11 countries will have more people earning over 30,000 US dollars than the United States. And it is that change in economic powerhouse that I think is going to have also an ongoing impact with regard to investment in these countries and the performance of these equity markets. Slide 10 is just highlighting what I indicated before, that the major countries there are Indonesia, Korea, Mexico and also Turkey. I think it is interesting to note that South Korea, all of us Samsung, would indicate that it is already a well and truly emerged economy, and yet Indonesia, Mexico and Turkey will be more powerful by the year 2025. Slide 11 and 12 here is just highlighting the vast difference that we place between those countries which are burdened with high levels of debt to GDP, like America, Europe and Japan, versus those countries, say, in the next 11 which are not. Here is a chart on slide 11 showing US federal expenditure versus revenue. The reason that there is that enormous gap is there on slide 12, and that is that in the 1960s, the US used to spend 4% of its money on Medicare and Medicaid. Now in 2012, it has to spend 23%. Social Security, it used to spend 8%, it now spends 20%. So going back to slide 11 there, that gap is unlikely to be closed anytime soon. Therefore, there are two major themes. One, that gap is going to be a continued burden to the US government, just as it is in Europe and Japan, and they will therefore have to print money to make up for that gap. And as a result, we think we will continue to see a devaluation of money, which is one of our ongoing themes that we've had for the last 10 years, but also that there's going to be a divergence or a continued divergence in the performance of equity markets, which are not burdened by this gap between expenditure and revenue. And you can see that in slide 13 in terms of the relative performance of equity markets. Japan, which has very high levels of debt to GDP over the last 12 years, has had a solid negative return. Whereas the S&P 500, where debt to GDP is between 80 and 100%, has given a zero return over the course of those 12 years, whereas the emerging markets countries have shown positive returns over that period of time. And we think the influence of low levels of debt to GDP certainly plays out with regard to why that has occurred. And you can see that again here. We chose those countries in the next 11 areas with low levels of debt to GDP and took a look at their annualized equity returns, whereas we compared that to the developed world and Japan, and you can see substantially lower annualized equity market returns. Coincidentally, those countries have high levels of debt to GDP. Slide 15 was just taking a look at the private consumption. You can see that over the course of 2008 and 2009, that broadly those next 11 countries are insulated from what's happening in the developed world, and we think that is likely to continue. Slide 16, taking a look at the weightings. Here is the next 11 countries as a percentage of the global population. They represent 20% of the global population. We think, therefore, that you should have at least 20% of the weighting towards equities in the next 11 countries. If you were to strip out those countries which are more developed with high levels of debt to GDP, then you can argue for a weighting in the next 11 countries of anywhere between, say, 20 and 40%. The next three slides here, 17, 18 and 19, are just referring to the country overlap that most people have in their portfolios. Going to slide 19 first, this is typically what we see in most portfolios of clients, a combination of brick and emerging markets or gems. The disappointment is that has a 41% geographical overlap. You do not get much diversification. We much more favour the other two. Slide 17, for example, emerging markets and next 11, where there is a 23% overlap, or even better, if you were to combine a brick fund with a next 11 fund, you get no geographical overlay. And we see that as being more optimal than here on slide 19, where there's a 41% country overlay, as most people's portfolios are placed today, and therefore suggests that perhaps that needs to be changed. Slide 20, which we can discuss personally with you, is our current weightings versus the Goldman Sachs fund and the index, the MSCI GDP Next 11 index, highlighting there that none of these funds have Iran as an exposure because of the embargo, as I mentioned to you. Next two slides, 21 and 22, just looking at the relative performance. Here is our Next 11 fund versus the MSCI Next 11 index since May. Broadly the same in terms of performance, and again on slide 22 you can see the Goldman Sachs Next 11 fund versus our Next 11 fund, broadly the same performance over that period of time. Going on to slide 23 here, just taking a look at the amount of money in the world versus the US versus Next 11. I do think the point is that you are going to get a substantial amount of money trying to squeeze its way into these Next 11 countries over the course of the next couple of years, but that will play out with regard to the relative performance over the course of the next decade. Nevertheless, I think you are going to continue to see a shift of money from world stock markets developed into the Next 11 countries. Then in conclusion, just taking at least 5 major points. First of all, equity markets with low levels of debt to GDP are going to continue to outperform equity markets with higher levels of debt to GDP. Emerging markets there basically outperforming more of the developed markets, the United States, Europe and Japan. The next 11 economies, of course, are not burdened with Social Security and Medicare and Medicaid, which those other 3 blocks of economic countries will always be burdened with. The number of people by 2025, which is why we're reassessing the importance of these countries, earning over $30,000 will actually exceed the United States. That in itself is very powerful. We go back to those 3 other sides and recommend that perhaps the optimal mix is a combination of BRIC and Next 11, not as most people are currently placed with a GEMS fund and a BRIC fund today because of the geographical overlay. And then lastly, just taking a look at the amount of money in world markets, 54 trillion, and the size of Next 11 markets of 3.3 trillion, and you can certainly see the shift that could occur from those markets into the Next 11 countries. If you need further information on that, by all means, please get back to us and we'd be more than happy to discuss that with you in detail. Thank you.